Risk aversion examines how investor preferences toward risk influence portfolio selection and investment decisions within the program. Risk aversion refers to the tendency of investors to prefer lower risk when expected returns are equal. Most investors are considered risk-averse because they require additional expected return as compensation for accepting higher uncertainty. The relationship between risk and return is therefore central to investment management and portfolio construction. Investors balance the desire for higher returns against the discomfort associated with potential losses and volatility. Understanding risk aversion helps financial professionals design portfolios that align with client objectives, constraints, time horizons, liquidity needs, and emotional tolerance for market fluctuations and uncertainty. The topic explains that investor utility reflects the satisfaction or benefit gained from investment outcomes. Utility increases with higher expected returns but decreases as portfolio risk rises. Risk-averse investors therefore seek to maximize utility rather than simply maximize return. Two portfolios with identical expected returns may provide different utility levels depending on their risk characteristics. Investors generally prefer more stable return patterns because uncertainty creates the possibility of unfavorable outcomes. The degree of risk aversion varies among individuals and institutions based on financial circumstances, investment objectives, experience, and psychological preferences. Highly risk-averse investors prioritize capital preservation and stability, while less risk-averse investors may accept greater volatility in pursuit of higher expected long-term returns. A key concept introduced in the topic is the risk-return trade-off. Investments offering higher expected returns usually involve greater uncertainty and volatility. For example, equities historically generate higher long-term returns than government bonds or cash equivalents, but they also exhibit significantly greater price fluctuations. Risk-averse investors may allocate larger portions of their portfolios to lower-risk assets such as high-quality bonds or cash. More aggressive investors may favor equities or alternative investments despite higher volatility. Rational portfolio construction therefore requires balancing expected return opportunities against acceptable levels of risk exposure. This trade-off forms the basis for modern portfolio theory and strategic asset allocation decisions across financial markets. The topic also discusses indifference curves, which illustrate combinations of risk and expected return that provide equal utility to an investor. Indifference curves slope upward because investors require higher expected returns to compensate for higher risk. More risk-averse investors have steeper indifference curves, indicating they require substantial additional return before accepting increased risk. Less risk-averse investors are more willing to tolerate volatility for relatively smaller increases in expected return. Portfolio selection occurs where the highest attainable indifference curve intersects with available investment opportunities. This framework helps explain why different investors choose different portfolios even when faced with identical market conditions and investment choices. Risk aversion has important implications for portfolio diversification and asset allocation. Diversification allows investors to reduce portfolio risk by combining assets with imperfect correlations. Risk-averse investors benefit significantly from diversification because it lowers overall volatility without necessarily reducing expected return. As a result, diversified portfolios are generally preferred to concentrated positions in individual securities. Asset allocation decisions among equities, fixed income, cash, and alternative investments are also strongly influenced by investor risk tolerance. Younger investors with long time horizons may tolerate greater short-term volatility, while retirees or institutions with immediate liabilities may prioritize stability and liquidity. Effective investment management therefore requires careful assessment of each investor's willingness and ability to bear risk. Overall, topic demonstrates that risk aversion is a fundamental concept underlying investment behavior and portfolio management. Investors differ in their tolerance for uncertainty, and these differences influence their preferences regarding portfolio risk and expected return. Utility theory, indifference curves, and the risk-return trade-off provide analytical frameworks for understanding how rational investors make portfolio choices. Risk aversion also explains the importance of diversification and strategic asset allocation in reducing unnecessary risk while pursuing investment objectives. For CFA candidates, mastering the principles of risk aversion is essential because they form the conceptual foundation for portfolio optimization, capital allocation, behavioral finance, and client suitability analysis throughout professional investment management practice.